Hello and welcome to this week's video tutorial for Heriot-Watt University Trading and Investment Club. In this video we'll discuss balance sheet, what it means for the investor to analyze financial ratios based on a balance sheet and why it matters for the investor. Balance sheet is a financial statement that summarizes company's assets, liabilities and shareholders' equity at a specific point of time. These three segments of the balance sheet give investors an idea what company owns, owes, and the money invested by the shareholders. And therefore, three segments of the balance sheet are assets, liabilities, and shareholders' equity. Assets will be a positive value, while liabilities, what company owes to creditors or banks or another companies, will be a negative value. Therefore, it will be in the brackets, and the sum of these two will give us a net asset value. As the name suggests, balance sheet, it has to balance. Therefore, the net asset value will be the same as the shareholders' equity. Now I will discuss assets and liabilities in depth. Company can hold many types of assets, and those include fixed assets and current assets. Fixed assets, sometimes called non-current assets. Current assets are those that will last no more than 1 year within the company, and therefore it includes cash, cash equivalents, bank, debtors, prepayments, things that will be liquidated into cash within 1 financial year. Fixed assets are those that will last within the company for more than 1 year, and therefore those include buildings, vehicles, machinery, equipment. Assets are things that company own at the particular date of time, and therefore cash, debtors or called trade receivables, bank, of course if positive balance, prepayments or stock or inventory, or property within a longer than 1 year period of time, office equipment, vehicles, machinery and so on. On the other hand, we've got liabilities, which are things that company owe to other companies, banks, creditors. With liabilities we have very similar classification to assets, and therefore we've got the long-term liabilities that will last more than 1 year, and current liabilities that falls due within 1 year. And therefore current liabilities will include bank overdraft, creditors, or also called trade payables, accruals. On the other hand, long-term liabilities will include mortgage for property as well as long-term loans. Therefore, liabilities falls into the same classifications as assets, as those that fall due within 1 calendar year and those that will last for more than a year. The third part of the balance sheet, the shareholders' equity, simply tells the investors how much money is invested by the shareholders into the company. There is a very simple equation to express three sectors of the balance sheet. Assets equals to liabilities plus shareholders' equity. All the assets within the companies, the value of those assets will equal to what company owes, what company borrow from other companies to finance those assets, as well as money that has been put by the shareholders of the company. Now we'll draft a very short and simple balance sheet to show the layout of the three sectors, and then use that layout to describe the financial ratios and how can we simply extract information from the balance sheet to calculate those to help us within the investment process. The name of balance sheet means that the two columns has to balance and therefore this number has to balance to the total assets will have to balance to all the total liabilities plus the shareholders' equity. I will draw a different format of balance sheet now. Current assets less the current liabilities gives us the working capital of the company. That working capital of the company plus the amount of fixed assets this format of balance sheet shows the fixed assets, then current assets and current liabilities giving the working capital, and in addition to fixed assets then we need to deduct the long-term liabilities to give us the net assets of the company, and the net asset value should always be balanced to the shareholders' equity. Balance sheet can be used to calculate many financial ratios. One group of ratios that can be calculated using the balance sheet are the liquidity ratios. And those include current ratio simply compares the current assets to current liabilities. Proportion somewhere between 1.5 to 1 up to 3 to 1. This means that there is 1.5 more assets, current assets, than current liabilities. And this one means that there is 3 times more current assets to current liabilities. And therefore it shows that the business is very healthy in terms of balance sheet, in terms of holding more current assets to satisfy the obligation to the creditors. Quick ratio is very similar to current ratio. It simply takes the current assets but takes away the stock or inventory from them, as stock is not often as liquid as cash would be, and therefore it's a quicker version of the current ratio. Cash ratio, however, compares only cash to current liabilities, and therefore company ability to pay the current liabilities straight away just from cash. More about ratios and ratio analysis we'll discuss in further videos. That's everything for today. Thank you very much for watching and see you next week. Thank you.